Welcome to the Stock Out. This is your show at FreightWaves where we set aside a little bit of time to talk about the consumer packaged goods, the CPG industry, which is a lot of the products in the center of the grocery store. And actually, the CPG industry makes up about 1/5 of all freight transportation. So really an important sector to follow as far as the shipper community is concerned. So today's topics, I'm going to talk a little bit about the Kroger-Alberstons merger, an update on that. That's pretty big implications for the CPGs that sell into those grocery stores. And Treehouse Foods, I'll talk about them. Treehouse Foods give you some sense of what's happening with national brands versus private label. Treehouse is the company that makes a lot of these private label brands. I'll talk a little bit about Pepsi, which is the biggest snacking company, and talk a little bit about what their management said about the market, relates to what a lot of the other big CPG companies has recently said. And then, of course, I'll go through some data on the freight markets per my usual. So I'll do those things. But before I get into that content, I would encourage you, if you're not already signed up for the Stock Out newsletter, to please go to www.freightwaves.com/the stock out. We send out a newsletter. That's right there at the top. You can just go to freightwaves.com up to newsletters, and then right under supply chains, you see the stock out, which is our CPG newsletter. You may also be interested in that retail newsletter, or also there's a cold chain newsletter as well. So I think there's some overlap between the audiences of those newsletters, which we send out one of those for each of those topics every week. So I'd encourage you to go do that, and also would encourage you to go sign up for our virtual conference, Global Supply Chain Week, which takes place next week. And we have a number of companies on day 2 that are related to the CPG industry. One of those is Tom Madrecki from the Consumer Brands Association. That's an industry association that represents a lot of the major, I would say most of the major CPG companies, both in food and outside of food. And then we have Herman Hackstein, who really knows the rail car market inside and out. I'm going to be interviewing him for that day 2 of Global Supply Chain Week. So I'd encourage you to check that out as well. And with that as just a little bit of an intro, get into the content today. Topic number 1. Give a little bit of a Kroger and Albertsons merger update. So, according to Reuters, these companies are now working on finding potential buyers for between 250 and 350 locations that could bring in $1 billion in proceeds after divesting those locations. So, upon this merger, there's a number of geographic markets where there's a lot of overlap between Kroger and Albertsons. Some of those would include the Pacific Northwest, Seattle. They have a lot of both of those, Southern California, Phoenix, and Chicago, including Dallas. I have a number right here, both of Kroger and Albertsons under the Tom Thumb name. So they had previously said that they're going to divest somewhere between 100 and 375 stores. So they're sort of narrowing that down to 250 to 350. The merger is contingent upon a divestiture ceiling of 650 stores. So the companies are shopping that out, looking for buyers. Some of the potential buyers that they're talking to, according to Reuters, Stop and Shop, the giant food company Food Lion, and Hannaford Markets, which operates in the Northeast. So those are some of the buyers, and the companies are still saying that they're on track to have a early 2024 closing. I know a lot of the stock analysts, industry observers have their doubts that it's going to come that quickly in light of potentially lengthy process from the Federal Trade Commission, which oversees all the antitrust issues, has to approve this merger. Some could say it could take 2 years plus from the time of the announcement, so it could be into 2025. But in any event, in early December, there was another hint as far as what the timeline might be. Kroger received a second request for information from the FTC, and some suggested that means that the antitrust investigation is maybe going into a little bit more in depth. That they're going to really have to demonstrate that there's not an anti-competitive nature to the traditional grocery business in some of these core markets. The other update is that Albertsons, did if you haven't seen it, was able to pay out the dividend, the $4 billion dividend that was really contested by a lot of states. It was after being delayed about 11 weeks. There were certain jurisdictions that said, well, Albertsons really shouldn't be able to pay that out because it's going to weaken the company, and therefore Kroger is going to have to acquire Albertsons, and that's why it's going to get approved. I didn't think it was all that argument was all that convincing, and was happy to see that they were able to pay that out. So as far as the merger goes, I think there are some points that could make it a clear negative for the CPG. Sort of most obviously is you just have a more concentrated customer base. Most of the big CPGs report that Walmart is about a 20% customer of theirs, far and large their largest customer, and that no other company makes up more than 10% of their sales. Kroger, now acquiring Albertsons, likely to make it a second customer that's more than 10% of sales. You do have a little bit more customer concentration. The other thing that comes to mind is that both Kroger and Albertsons have significant private label brands that are pretty worthwhile. And they both say that their private label brands are about 20% of their sales. But those retailers also say that they're really good in different areas. And so potentially the private label penetration for those, the combined retailer will be higher. They'll maybe take the better of the brands at each location, and it might make it a little bit more difficult for some of the national CPG brands selling into those. There are some potential positives, I think, when you're thinking about this merger from the CPG perspective. And really sort of the main thing that comes to mind is the potential to leverage Kroger's data, which is really going to be strong after they acquire Albertsons. They're going to have data on about 100 million households in the United States, which is pretty much everyone that buys groceries at a traditional grocer. And so potentially CPGs could leverage that data in order to target advertising to specific demographics. If they're selling, Powerade, and they know the data that of everyone that buys Gatorade, maybe they could give Powerade away for free or 50 cents a bottle or something like that to those specific customers that are in the habit of buying the competing product. And that's just sort of one example. Another thing that could come of the merger that's a positive for CPG is they could potentially lower their costs by streamlining logistics. I think when you just have one retailer, you can streamline your costs a little bit. And then the other potential is, we know that these traditional grocers are losing market share to a lot of the discounters, including the Aldi's, Trader Joe's of the world, have good prices because they're so heavily private label. You don't want that traditional grocer that relies heavily on those national brands to go away. So if this is something that keeps it in business and healthy, I think that is helpful to CPG companies. I'll move on to topic number 2, which is related, also on the grocer channel, and that's Treehouse Foods sees private label taking share. Now, they would say that they're the private label manufacturer. They manufacture private label groceries for companies like Aldi and Trader Joe's. Some of the interesting things they said was on the unit volume growth. The company said that its fourth quarter unit volume growth was 3.4%, and that's versus basically flat for all private label brands in the categories that it competes in, and a 5% decrease for national brands. So they actually see a pretty significant market share gain for the private label brands, something like 840 basis points. So that's pretty dramatic. And they're basing that on IRI's point of sale data that comes out every month, which is something that I look at also. I think it's pretty good. We did have IRI on one of the shows, I think it was last year. So the price gap for private labels, they say, is about 25% presently. It looks like it did come down in the most recent month, was sort of in that high 20% range, because the private label brands have increased their price maybe even a little bit more. One of the interesting things that came out of Treehouse is earnings. They said their net sales growth in the fourth quarter was 22% on a 2.2% volume and mix decline and a price increase of 24.6%. So that is outpacing a lot of what we're seeing from the national CPG brands, which is up more like 15%. but really, high prices sort of across the board, but particularly in private label. Still have that gap there where a consumer can save money going to private label. Treehouse also said, and this is important, they said their supply chain recovery costs are helping keep some costs under control. Also hearing that from some of the national brands, Kellogg said that. I think some of the others have said that as well, that at least, maybe still seeing some more supply chain challenges than what is quote unquote normal, but it's, better than it was. Treehouse targeting 3 to 5% net sales growth this year and 8 to 10% adjusted EBITDA growth. So it looks like they're planning to have a better 2023 versus the last couple of years, where I think they got caught on margin decline from all the cost pressure that they were experiencing and the supply chain issues that they were experiencing. Also related to this topic, there was a good article on CNET, which typically is related to computers and personal technology, but they had an article that said Trader Joe's was cheaper than a traditional grocery store by about 33% on like items. So not too different than that 25% that Treehouse claims. And then they said Aldi was about 4% cheaper than Trader Joe's. So it's pretty easy from that to see why some of these private label heavy grocery stores are taking share from traditional retailers. Aldi in particular is expanding nicely, really adding a lot of locations. And Aldi is the one that consumers tend to give the highest praise to, although everyone seems to like Trader Joe's as well. I was just there the other day and was completely packed. I'm going to move on to talking about some of the CPG companies maybe directly. And this one is Pepsi says its inflationary pressure persists. And so they said their inflationary cost pressure persists into 2023. There are some interesting lines here about some of their costs. And they said the Frito-Lay North America, which is the segment that they call the crown jewel, that snacking segment, they said they had a 19 percentage point impact from higher commodity costs, which consists of primarily cooking oil, seasoning, and potatoes, and higher advertising and marketing. Okay, the advertising and marketing is discretionary, but a lot of just higher inputs for things like potato chips. The segment still has a 27% operating margin. So I think the idea is it's already at a high margin. You want to grow the revenue, and even if the margin doesn't get any better, it's take some of those brands, localize them to other regions across the country. They've done a nice job of doing that. They also said, talked about costs in the Pepsi business, the soft drink business. They say PepsiCo Beverages had a 53 percentage point increase on higher commodity costs, primarily fuel and resin. So I believe that goes into the packaging. Operating profit in PepsiCo Beverages North America still increased 13% despite those cost pressures. So clearly taking pricing up a lot there. And then there was an interesting quote they had on what they expect for pricing on shelves. And so the company's CFO told Reuters, we have most of our price increases for the year already in place. That comes after multiple rounds of increasing prices throughout last year. They said their fourth quarter average price increases increased 16%, while organic volumes fell 2%. So not a tremendous amount of elasticity there. I think most CPG companies would take that, a 2% volume decline when you're increasing your prices 16%. So they also said organic revenue growth is expected to increase 6% this year and 8% EPS growth. So still seeing top line and bottom line results. And they did seem cautious though on the consumer, and it made it sound like that elasticity could increase. They said that their volumes might be down again in 2023. Wouldn't be shocked if there was a mild recession in the U.S. And so it's something I think we've heard from a number of different CPG companies saying that their elasticities are low. Consumers not necessarily changing their purchasing behavior yet, but they're seeing the elasticities creep up where consumers are cutting back a little bit in terms of number of items they're buying. Certainly that data I talked about earlier with Treehouse Foods would support that. And that also gets to what I think is really sort of the topic of the hour in CPGs is the relationship between the CPG companies and the retailers they're selling to. the retailers mostly want lower prices now, or prices that at least don't increase. But a number of the CPGs say that their costs are still inflating. Mondelez said their costs are still rising double digits in 2023. Unilever said that we may be past peak inflation, but their costs are still rising. So kind of prices rising, but maybe rising at a slower rate. And then Nestle, who reports on Thursday, maybe we'll get some more detail, but they said that they still have some catching up to do in terms of prices still need to rise in order to make up for the cost that they've seen, rise last couple of years. And I think a lot of CPGs sort of feel like they're kind of behind the eight ball on pricing because their costs rose, strongly last couple of years. And even with pricing up for most CPGs 15% versus where they were a year ago, and that's on top of a double-digit price from the year before. A lot of them have lower gross margins than they did before the pandemic, so they're still looking to sort of make up for that decline in margin. With that, I'll go on to the next segment, which I'll talk a little bit about the freight markets. And so first thing that comes to mind here is really the falling imports should help keep freight markets loose. Zach Strickland over the weekend wrote his Chart of the Week article, which I would encourage everyone to sort of get in the habit of reading. Zach's Chart of the Week article. It usually comes out on Saturday, where he goes through some data point in FreightWaves Sonar that just really stands out. And he looks at everything and just kind of says, okay, this is kind of the highlight. If I could highlight one thing, this would be it. And have a Sonar chart on the inbound ocean TEU volume index. And so this is a unique data set that's based on when containers are booked for import at the point of origin, which is often China being the largest overseas trading partner. And really, you saw these, the orange line is 2022. You saw those really fall off a cliff starting in about May of last year. And that's when my colleague Henry Byers made the big article on, the ocean imports are falling off a cliff. That didn't happen for a few months later because there was such a backlog at the ports and because those container ships move so slowly. But eventually it did happen, and that's really we're still seeing the impact of that. Sort of the port of Long Beach in January had a 32% decline in January in terms of loaded container TEUs. In terms of container volume, down 28.4%. So let's call it in round numbers, down 30% versus where it was a year ago. That's helping to keep the freight markets loose overall, and in particular on the West Coast, where you have those tender rejection rates in the low single-digit range. So they're very easy to get a truck on the West Coast, and truckload is very competitive with intermodal, including in some of the lanes that traditionally have been kind of intermodal lanes. You think about something like an LA to Dallas, truckload's not usually competitive, but I would say it's competitive, right now. So that was one that really, stood out. I'll move on to another chart from Sonar, which is the van contract rates. And if we could bring up the van contract. So this is from a company that processes transactions, and you can see 2023 year to date is the white line, and the dry van contract rates that have been processed. We have the data through about the end of January at this point, down 7.8% on average versus where they were in 2022. And you see at the very beginning of the year, closer to in line. So that's accelerated. And, that implies that the contracts that are rolling over down double digits because that's an average and some haven't been repriced yet. And so would encourage shippers to keep some of these national averages in mind that we have in Sonar with data points like this, and would also encourage those to sign up for Sonar so they could see their specific lanes that they're running and see all the data in those lanes, including the contract rates, which we have through our SCI tool. You can see exactly the contract rates of the lanes that you're running, tender rejection rates in the lanes that you're running, et cetera. So basically, if I was a shipper and looking at this and you're seeing the rates coming down, maybe you're at a point where you're starting to think about longer term, contracts, if that's possible. I know some of the truckload companies are talking about keeping the durations of some of these contracts short, maybe more mini bids because they don't know whether the market is going to improve. I think the trajectory of the freight economy to a large extent depends on your view of when inventories are going to be right sized. We're still in this period of drawing down, inventories, but those things tend to overcorrect where we got to have too much inventory, then we sort of shut off the imports, and at some point we're probably going to overcorrect to the downside, and we're not going to have enough goods in inventory to move to the end market. So at that point, there'll have to be a restocking. That restocking could tighten up the freight market. So that's something to watch. Another one that I would look at if I was a CPG company, want to move to the next chart, the van contract rates, and comparing those to the van spot rates, if we could bring that up. And so this line is from two different sources. The one in white is from a company that processes transactions, and that's the contract rate. So we're saying on average, excluding fuel, $2.56 on a nationwide basis. In orange is, we call it the NTIL 12, which is going to be spot rates that exclude, there's an algorithm there to exclude fuel surcharges, and that is from a consortium of brokers that provide us with data on a daily basis. And so, really since kind of almost this time last year, the spot rates have been below the contract rates, and they've been kind of unsustainably below the contract rates. And that's still true. You sort of look at the spread there, and it shows that spot rates, when you back out fuel from the spot rates, still about 60% below the contract rates. And so, if I'm a shipper and I'm looking at this, I'd say, well, I still think, contract rates have a significant amount of distance to fall. It wasn't clear that was true maybe right at the end of last year. And a lot of that spike you see at the right part of the chart was related to just some tightness, around the holiday season. That seems to have come back in. Now we're in kind of a seasonal slow part of the year, being impacted by Chinese New Year, not yet at the point where retailers are making a big push to stock summer merchandise. Usually that starts to heat up in March. And so, thinking forward, I really think March this year is going to be an indicator of how strong the freight markets are going to be for the rest of the year. And there's actually a fair amount of optimism when, at least the carriers that talk to Wall Street talk about how the rest of the year is going to play out, where a lot feel that, once we get into the second half of the year, at that point, the inventories will be low enough. They'll need to be restocked. You'll see a resurgence in demand. And that's really it's going to tighten up the freight markets. That or capacity coming out of the marketplace, which you think that has to happen given how weak the freight markets have been. So that's kind of the bull case, eventual inventory restocking with capacity coming out. The bear case is no one is ever going to buy anything that is discretionary again, because groceries, fuel, utilities. Now, auto insurance has gotten to be hugely inflationary. People are renting houses. Those rents have been reset higher, that there's just not a lot of discretionary income for anything fun. You sort of look at the consumer data, and the credit card balances are well above where they were pre-pandemic levels after coming down. The savings rate is now down to about 3%. It basically went from 8% before the pandemic to 19% during the pandemic, now down to 3%. So people aren't saving very much. They're putting more on their credit cards, and people are cutting back, where they can. There was a gym near me that cut its monthly membership price in half, which tells you that people are not, renewing their gym membership. So people do seem to be cutting back where they can. Now, gym membership isn't going to move a lot of freight, but I think when people cut back on those discretionary items, they're cutting back also on things they don't necessarily need to buy, clothing, furniture, electronics. Those things are really hurting. We've done some interesting pieces on FreightWaves about, Rachel Premack put out a few things on other sort of alternative indicators of economic activity. She wrote one article about cardboard boxes, how those are down, another one about bubble wrap, how that is down, which tend to be more valuable items will be shipped in bubble wrap, and then this latest one about beer sales, which relates to CPG and also this concept of trading down, maybe not necessarily consuming less, but consuming different brands, which is a reversal of what we saw during the pandemic, where during the pandemic, people had more money to spend. They opted for the higher end products on pretty much everything. So really, that's what I wanted to go over today. I'll send out the newsletter on Wednesday. And, with that, hope everyone has a good day.